Okay, so hello everyone. My name is Vikas Agrawal, and I am the founder of AIF and PMS Experts India. So AIF is your alternate investment funds, and PMS is portfolio management services. Well, some of you might be aware that there has been good amount of changes in terms of taxation, especially in the mutual fund space. So we thought of organizing this call, and we've invited somebody who's got 15 years of experience in this area, and we thought who would be the better person than Dipen to sort of come and explain and speak to all of us and explain what has happened in the recent past in terms of taxation on the fixed income side, mutual funds, and we'll at the same time talk about how AIF will shape up going ahead. So, thank you, Dipen, for accepting a request and taking the time out from your busy schedule.
Our pleasure.
Yeah,
Thanks, Vikas.
thank you. So, let me introduce Dipen. So, Dipen is the Vice President, Head of Product at Vivriti Asset Management. Vivriti is one of the largest player when it comes to alternate investment funds, especially in Cat 2 fixed income side. So he's in fact the founding member. He's instrumental in terms of setting up not only the asset management business for Vivriti and their innovative products, but at the same time he's played important role in terms of coming out with unique offerings for their investors. In terms of generating good higher yield, I would say. So he brings about 15 years of experience, as I mentioned, and he's a CA and CFA by qualification, and he's worked with large organizations like CRISIL on the credit rating side. He's also had an opportunity to work with large players like Aditya Birla Finance, where he's sharpened his skill set in terms of AIF. So now with that, we'll start the conversation. So format of the show, Dipen, is what we essentially do is while we'll come to the topic, which is very very important and relevant from what's happening currently in our in terms of the taxation changes. But before that, if there is anything in your mind, you're requested to put up any presentation if you wish to, and then we'll keep asking those questions. You're not audible. You are not audible.
Yeah, sorry, I wasn't.
Yeah.
Yeah. So, thanks, Vikas, and thanks for all of you joining on the call. A warm welcome from everyone from us at Vivriti EMC, and pleasure to have you on the call. And thanks for joining the call. So, I have a brief presentation. We keep it crisp and precise. We have an important few slides to cover. It will be very helpful if people and all of you can keep the session interactive and use the Q&A or the chat window which you have. We will take all your questions once I complete my presentation. But I'm looking forward to making the session as interactive as possible. So I'll just share my screen and then we can sort of take it forward from there.
Sure.
Yeah. Because is my screen visible?
Yes, very much.
Okay, good. Yeah, thanks. So before we sort of jump deeper into the specific changes, I believe this budget had few couple of key and I believe game-changing changes event from a budget perspective, and which actually impacts how people assess and invest into debt investment side. So one obviously is the changes on mutual funds, which we'll sort of cover in more detail. The other one which came was for market-linked debentures. And all in all, our view is that the tax advantage, I would say, or tax arbitrage available to debt mutual funds or market-linked debentures has got removed. And now every debt instrument, be it bank FD or national serving certificate to your mutual funds, AIF, PMS, all are in the same level playing field. And this, I think, to us, especially in terms of alternative investment space, we believe that this is something which is a fairly large change and a game changer event in the way the alternatives will scale up. So we'll first cover the impact on few segments, and then we'll sort of cover our takeaways. And we would also want to cover how investors should now go about their assessment on investing in the debt products. And then we sort of take questions and answers. Now, coming first to mutual funds. So, as compared to Feb, when the union budget got presented, nothing was sort of prescribed. And the amendment which came just before the bill got presented in the Lok Sabha came as a surprise to a lot of participants. This change, which is there, basically removes any advantage available to mutual funds or debt mutual funds. And technically, they have specified category which is called as special mutual funds, defined as instruments where the investment in equity is where no more than 35% is but essentially the long-term gain. So previously, mutual funds and debt mutual funds, if you hold the securities for 3 years, you were entitled to take long-term capital gain benefit with a 20% taxation and a post-indexation benefit. Now that has been sort of taken away, and every income, whether it's on one for a holding period of 1 year, 2 year, 3 years, or 5 years, gets taxed irrespective of the holding period for short-term capital gains. Now, it is obviously worthwhile to understand that short-term capital gains are taxed at the maximum marginal rate for the investors. So if the investor is falling in a low tax bracket of 10-20, it still gets taxed at that particular rate. Or vis-a-vis, if the investor is in the highest tax bracket, then it would get taxed at the higher tax bracket. Coming to the categories of mutual funds, which are, and now basically what is the impact? Up to 35% equity. So basically all categories of debt mutual funds, right from your overnight liquid to ultra short, short term, to corporate bonds, short term categories, gilt, etc. All that categories are sort of covered. It also sort of covers other categories like gold and silver ETF funds, international FOF, conservative hybrid, and certain categories if the equity allocation is less than 35%. And only equity products where, let's say, the allocation to equity is more than 35%, like the hybrid funds or the arbitrage funds or the pure play domestic equity funds, get the benefit of long-term capital gains or lower short-term capital gains, right? So this category where mutual funds debt product falls is taxed at the short-term capital gains, and long-term capital gains benefit is sort of taken away post this budget. The other impact is
Can you go back to previous slide once again and explain this in detail a bit to our investors, if you don't mind?
Sure. So, see, technically, the way the definition of the specified mutual fund is, right, they are technically saying that any product where the allocation to equity, and I'm just sort of referring to the previous slide, where not more than 35% is invested in equity shares, is a specified mutual fund, and the taxation of that is to be at short-term capital gains, irrespective of the holding period. And short-term capital gains gets taxed at your maximum marginal rate. Now, if we read this slide along with the definition, so up to 35% allocation in equity. So most of these categories obviously have either null or nil percentage allocation to equity, or they may have only a smaller allocation to equity. So if the allocation is smaller to equity, like the conservative hybrid category, even those those categories are sort of covered. So all debt mutual funds do not have allocation to equities. Gold and silver ETF obviously do not have allocation to equity. International FOF, because this is not domestic equity and it is an international equity, the benefit is accorded only to domestic equity exposures. And all these categories which is mentioned gets taxed at the short-term capital gain, capital gain. And as I said, if the investor has short-term capital gains, it gets covered in the applicable tax slab rate. The long-term capital gain benefit is not available for these categories of mutual funds. Right? And essentially, the benefit of long-term capital gains of 10% or short-term capital gains of 15% is sort of available only for categories where the allocation to equity is more than 35%. And by nature, right? So all your domestic equity categories like your large cap, mid cap, small cap, multi cap, etc., are pure play domestic equity. They continue to obviously have. So there's no impact on equity or equity oriented mutual funds. And equity oriented is defined where the allocation in that particular fund is more than 35%. Yeah. The other impact was in terms of market-linked debentures. Now, if I just take a step back, market-linked debentures are still NCDs where the coupon or the income on that debenture was sort of linked to an external index stroke securities, like for your example, a Nifty 50 index or a government 10-year government securities, etc. And it was construed, and a view was sort of taken that if the instrument was held for a period of, so if it was a listed MLD and it was held for more than 12 months, the long-term capital gain benefit of 10% was sort of available for listed MLDs. However, the change which has happened, and they have sort of defined market-linked debentures, any income which sort of comes from MLDs and whether it's listed or unlisted, and whether that is arising as a result of whether you sell down the MLD or whether you hold the MLD till maturity, gets taxed at short-term capital gains. And this is again irrespective of the nature of holding period. Now, obviously, short-term capital gains, the impact is higher because it gets taxed at the maximum marginal rate of the investors. And in the amendment which came in March, there are no changes which has happened. So one of the key difference between mutual fund taxation, which came into in the mutual fund taxation proposed change came in March, is that they have given a grandfathering for any investment done up till 31st March 2023. So if you're holding any investments or making any incremental investments till 31st of March, you can still get the benefit which was previously sort of available. However, in case of market-linked debentures, even if you had invested in a market-linked debenture 1 year, 2 year back, there was no grandfathering which was proposed in Feb. Neither any grandfathering is sort of proposed in March or in the amended bill. Right, so that's the key difference. Mutual fund, given the large segment, so mutual fund debt AUM could be around 12 lakh crores. Market-linked debentures was a relatively smaller size, but it was still a decent size. The outstanding, to our understanding, was over 75,000 crores of MLDs, which were impacted. There is obviously a small point, and I'm not sure it's not so relevant for our domestic investors, so I can skip the slide, which is on GIFT City.
If you wish to cover, you can cover it up.
Yeah, sure. So, as you guys know, that the GIFT City is an important regime, and that attracts a lot of offshore capital coming into India, or whether if the investment are being done from India to abroad. In the current budget, for category 3 AIF, which are set up in GIFT IFSC. Up till now, which is up till March 2023, because these vehicles are set up in India and those are residents from an income tax perspective, previously surcharge and cess was sort of applicable for interest and dividend income earned by Cat 3 AIF in IFSC, which now has been removed and proposed to be removed. So that's actually like a welcome change. So a Cat 3 AIF, which is set up in IFSC, the taxation previously was around 14.25 for a trust. That actually comes down to 10%. So there is an incentive being offered for IFSC-based funds. The other piece was in terms of TDS applicable for listed debt securities. Now, earlier issuers were not required to actually deduct TDS on interest income being paid on listed instruments. However, in Feb, basis the proposal, the TDS needs to be deducted by the issuer even for listed instruments. And to our mind, that can have some impact on the secondary sell downs of debentures. However, if you look at this, alternative investment funds who hold either listed or unlisted security has been given a specific exemption. So when an issuer is making a payment of income or interest to an investor, which is a category 1 or a category 2 AIF, there is no withholding implications because Cat 1 and Cat 2 have been accorded a pass-through status, and the TDS needs to be deducted at the time when the AIF is making those distributions or allocations. So there is obviously no need of double TDS being deducted for the government. Now, all this while we are speaking, the surcharge rate, for example, earlier the surcharge rate was 37% for investors above a particular income category. That has now been reduced to 25%, which means for an investor in the highest tax bracket, the effective taxation sort of comes down from 42.75% to 39%. And this is in the new income tax regime, which is proposed in Feb. And obviously, March, May, there were no further changes to the proposed finance bill. Now, with this, when we sort of look at and Vivriti, since we are leading asset manager, I've just used other examples here. Now, what we wanted to illustrate is that up till now, a lot of this comparisons on return was for HNIs and family offices. A lot of the comparison was always on post-tax returns because mutual funds enjoyed that tax advantage or arbitrage, and listed MLDs also enjoyed that post-tax advantage. Now, a simple illustration of, for example, one of a fund where our pre-tax, post fees and expenses, and post the hurdle rate to the investor is on a 13.3% pre-tax. That number, because it was taxed at the maximum marginal rate, and this illustration we have sort of created for investor in the highest tax bracket, was coming down all the way to 8.14%. Now, because the spread was not very attractive as compared to mutual funds in the erstwhile era, the spread was only 145 basis points. Now, what the government has done is that if a mutual fund is, let's say, giving a pre-tax return of 725, because of this March change, the return goes down all the way to 4.5% for a mutual fund. While the segment which was previously at 814 also still remains, because there is no change in the hands of the AIF. That continues to remain as pass-through. Now, what is more relevant now is to see the spread, which is now a post-tax spread. I have just used a post-tax illustration for simple comparison, but the spread now is at 350 basis points versus an erstwhile 150 basis points, which makes the AIF propositions far more interesting and comparing for the investors. And that's why one of our key beliefs is that this change should be actually like a game changer, because without changing the underlying risk, the only attractive product from a post tax was mutual funds, and that relative value comparison was always being accorded by or carried out by our investors. That being taken out, the change is a very positive change from an AI perspective. So all in all, our takeaways are that the budget actually creates a level playing field. And even if we sort of take into account the recent proposed changes by SEBI, and this is not a tax change, but it is an important change which may have an impact on the way investors or their wealth partners or distributors propose a product, where SEBI sort of have proposed capping on upfront fees which are being paid to distributors. So all in all of these changes we believe are creating a level playing field in the debt AI space. We believe pooled products like AIF and PMS should get a lot of traction, whereas mutual funds and standalone issuances, especially MLEs, will sort of dry up. While all of this is happening and AIF would get traction, it would be now more important for investors to decipher the strategy on what sort of strategy is the underlying asset manager running, whether it's a mutual fund product or a performing credit space or a venture debt or a distress, because now the comparison is only on pre-tax returns, which is the risk deciphering would become far more important for investors as they sort of evolve towards or get more attracted towards AI space. And to all in this, basically our view is that the true comparison, and there is an apple to apple comparison on risk versus rewards, and that's why I said the risk matrix needs to be deciphered by the investors in far more detail, and I'll sort of cover this in the next slide as well. We believe that this change would actually lead to development of corporate bond markets, which the government and SEBI have also sort of worked towards making these markets much more deeper. We see an increase in AA minus and below issuances, and that should lead to a deepening of the corporate bond markets. The last slide which I have is on, as an investor, how would you sort of now look at evaluating debt products post 1st of April? And it becomes very important. So these are a few points which we wanted to highlight from our side. Now, the first and the foremost piece, which is still very important, is the asset allocation of the investors. So, for example, allocations to equity, debt, within debt, what sort of products makes more sense, and then sort of tying the investment to the investment goal. So whether I'm investing for my buying a house after some years, buying a car, whether I'm saving for for my kids' marriage or my higher education, those investment goals needs to be mapped to the to the investments which you are making and the product which you're sort of selecting. The risk where basically whether returns can be generated using taking a call on interest rate, and whether you're sort of taking a duration call within risk, whether you're sort of taking credit risk, and whether the credit risk is, for example, of an underlying instrument, which is, let's say, a AA minus or an A rated or a triple B rated, or whether the company is unrated, whether the company is startup. All those factors would now have to be sort of carried out. Whether the product is exposed to an MTM, so for example, open-ended mutual funds will still be exposed to a lot of volatility in interest rates, and whether the product has liquidity on tap, and whether the product is closed-ended or an open-ended. So those are the considerations which the investors will need to make. Obviously, on returns, one key this thing is that now the post-tax returns sort of no longer matter. The taxation is broadly similar across all products. But it is important where when people sort of jump into AIF, an important matrix to always look at is pre-tax, post-management fees and expenses. After you incorporate the setup cost which the asset manager charges, what is the operating expenses or the cap which he's sort of proposing, and what is the sort of different form of fees and carried interest, whether the carried interest is charged or a carry is charged with catch up, without catch up, etc. And ultimately, the investor needs to ask the asset manager to give an illustration of what sort of return do I make on a pre-tax basis versus, and the investor obviously has to assess the risk which the strategy or the manager is sort of taking. Our sense is that we would see a lot of players, especially a lot of mutual funds jumping into the space as well. And we will see this space getting much more crowded, and investors would have a lot of choice. So it's become important for investors to pick the right asset managers who have a decent track record. And it's more important to sort of pick players who have a consistent focus, have the right team, and they've been investing with the same or similar strategy in the past. And they are not new entrants, but they have been focusing on that particular segment for a recent while. And last and most
Uh,
important is, yeah, sorry, Vikas.
yeah, yeah. Please go ahead.
Sorry, yeah. And the last point, which is more important, is also how is a product innovative and how is it different from other products in the market, and what is the value add which the product adds, what is the sort of risk which the product has versus how is this product a non-market linked product and adding to the reducing the overall risk in the portfolio of the investors. So those are some of the considerations which we would want to highlight for investors benefit.
Sure.
Yeah. So with this, I'll stop my presentation and I'll be happy to take down if there are any questions.
Right. So the first question is, so first of all, thank you so much for enlightening us with your thought process in terms of the changes which has been done recently by Ministry of Finance along with the regulator. Now the question is, so do have you noticed any sort of changes in the AIF side also, like in particularly in Cat 2, because some of the Cat 2 instruments, AIF investors do take exposure in the fixed income or sometimes mutual fund, fixed income mutual funds also as an underlying.
Yeah. So I don't think so because there are any changes which impacts the AIF, which is Cat 1 or Cat 2. That still remains as a pass-through status. And in fact, the change on TDS when the issuers make a payment on interest, that also does not have any impact on AIFs.
Right,
In fact, now I believe that if you see today, there are very few or limited products on Cat 3 in the fixed income space. You see a lot of products in Cat 3 equity, long short, or long equity. We see a good reason for people also or asset managers considering launching Cat 3 products in the fixed income space as well. So
right,
that's also a space which we should look out for in the short to medium term.
right. The other thing is, I'm just saying from an investor point of view.
Hmm.
So now that knowing the fact that mutual fund, particularly the fixed income, is not so-called tax efficient, uh, so now obviously they are asking what is the best option now available to them. So can you give us more idea about your funds, like which fund they should be looking at?
Yeah, so as we stand today, our philosophy, even before obviously this products, so we have three domestic category 2 AIFs, which we have currently working with. And our philosophy always has been to sort of offer different products in different risk reward brackets. And for us, risk reward sort of comes broadly. And as an asset manager, our focus is to sort of bring innovative products. So all these three funds, for example, are rated by rating agencies for capital protection. So one is, for example, a AA plus product, or rated by CRISIL for capital protection, that is known as Vivriti Wealth Optimizer Fund. The second product is known as Vivriti Alpha Debt Enhanced, which is rated by ICRA as ICRA A+. And we have a third product called Vivriti Emerging Corporate Bond Fund, which is rated A-. Now, obviously, because all these three products are sort of offering or working in a different risk bracket, investors basis their risk appetite uh, and uh, uh, and their return expectations can try and sort of identify which product, for example, makes a lot of sense for them. So, for example, the Wealth Optimizer Fund sort of offers almost a pre-tax of 10% pre-tax on a AA plus SO sort of product rated. Whereas on the most aggressive side, we have Vivriti Emerging Corporate Bond Fund, which is rated ICRA A minus, and there the pre-tax return can go as high as 13.5%.
So the second question is, what is the risk in the underlying investments of AIF when you compare that with mutual funds?
Yeah, so I think see, the risks are obviously different, but risk, for example, in case mutual funds typically, let's say, sort of focus on investing in triple A stroke AA plus or AA rated instruments. Whereas AIFs and there is a wide range of players who sort of offer in the space. Our focus as a group has always been investing in instruments which are in the performing credit space, as we sort of define, entities which are rated lower, let's say, right from AA minus all the way up to the investment grade, and bundle up those into products with different risk rewards. So, although the risks are different, but the returns sort of compensate far more than the risk which the products sort of entail. And as you sort of looked at the pre-tax spread for example, with the Emerging Corporate Bond Fund, which is rated ICRA A minus, goes all the way up to 6% pre-tax spread as compared to what 6 to 7% pre-tax spread as compared to what a AAA oriented mutual funds are offering. And we believe that the spread is extremely lucrative for investors to consider this particular product.
You also mentioned that there are other players who are also planning to come out with new innovative AIFs in this space because whatever has happened in the mutual fund side. So, can you give us a sense that which are the other ways that you can structure debt products in the AIF's platform?
Yeah, so I think the focus now on asset managers would be by creating a product. For example, our focus has been to create innovations. So two of our products are potentially the only products in the space where we actually also have loss protection offered to the extent of 7.5% or 10% of the outstanding capital contributions in the fund. So, features like this is something which we believe make the product far more lucrative for investors, where the sponsor or the manager, for example, commits a significant capital, and that too taking a subordinated position or a junior position in case of a loss. So this works like a first loss default guarantee by the manager or the sponsor, which is quite innovative, we believe, and there are very few players who offer this in the AF landscape.
Is Cat 2 now is more attractive with taxation aspect. Also, how Cat 2 able to provide debt instruments?
Yeah, sorry, if you can just rephrase your.
What he wants to know is that what are the underlyings in the Cat 2 in the AIF space?
Yeah, so see, Cat 2 AF, if you take an industry snapshot, more than 80-85% of the AF commitments are now in the category 2 AIF space. Cat 2 AIF, you can basically invest into equity, debt, whether in credit or real estate or venture debt. Most of the players are in the Cat 2. There is no restrictions in terms of what instruments we can typically do, but most of the investments are in form of NCDs or CPs, for example, largely. And then obviously the range of companies can sort of vary from, as I said, a company which is in a AA bracket to a A bracket to a triple B bracket, or whether the company is actually under and non-banked.
How diversified is the underlying portfolio?
So, I'll take example of Vivriti here because I'm more privy to that information here. Most of our products sort of run with an average exposure of around 5 to 6%. So, the example of one of the fund which we referred with the Emerging Corporate Bond Fund targets an average exposure of 5%. And today that product already has investments of around 14 investments plus, and we would reach around 20 plus investments by the time we are closed.
Okay. So you're saying that, see, so when you say pass through, for the benefit of our investors, can you explain this? What do you mean by pass through in Cat 2, Cat 1 and Cat 2?
Yeah. So when we say pass through, from an income tax perspective, it is treated as if the investor. So let's say there are underlying bonds, there is a AIF, and then there are investors. It is assumed that this vehicle in between an AIF does not exist. The investor directly invested in the bond. So, for example, if the investor directly made an investment in an NCD, it would be treated as interest income, which is taxed under the head income from other sources. And income from other sources, the income gets taxed added to your income, total income, and that gets taxed at the maximum marginal rate. So basically at the slab rate. So that's how the AIF work. A Cat 1 and a Cat 2 pass through status work.
In Cat 3, you have, there's no pass through. So in Cat 3, all the taxes are paid at the instrument level.
Fine. Yeah, so in Cat 3 AIF, because Cat 3 are not accorded the pass through status, that means the tax paying vehicle is the AIF itself. And depending on whether you set up the vehicle as trust or an LLP or a corporate, the taxation rates, given that we have differential taxation or the surcharge rates for your different vehicles, the applicable tax rate.
Right.
So the tax is paid at the AIF, and then whenever the income gets paid out from the AIF to the investor, it is exempt in the hands of the investor.
Right. So far, if you look at the industry, you have a lot of players on the Cat 3 side. So more than 70,000 crores have been garnered in terms of assets in last few years in Cat 3. But as he rightly mentioned that some of the industry players are planning to come out with debt funds in Cat 3. Let's see, how it is going to shape up. So, but yeah, they would be looking at investing in bonds, etc. from there. But yes, the whatever would be the tax, you are not paying, but the fund is paying. So in a way, it is going from your pocket only. So there are few investors who gets confused that they don't have to pay, the fund is paying, but actually it is going out of your pockets because you're treated like an equal partner out there in the LLP
Yeah.
sector or a trust, and you get allotment of units. So आप कान यहाँ से पकड़िए यहाँ से पकड़िए पैसा तो आपके जेब से ही जा रहा है. So I think you need to be very, very careful about it. Next question comes from Mr. Bhansali that, can to how much lowest rating category you are going for investment. So basically, he's talking about what sort of ratings that you're maintaining at the fund level.
Yeah, so when we sort of invest, for example, we are the only asset manager in the space, in the debt space, where today 100% of our investments are rated, 100% of them have a bank funding, and 100% of them are rated in the investment grade. Typically, a lot of the other asset managers hold instruments which are lending to holding companies, or companies are new age or startups, especially the venture debt categories. There, generally, most of the entities remain unrated, and typically, a company would opt to remain unrated, where the company believes that if they were to go for a rating, the entity would get a rating in the non-investment grade. So that's the borderline which we sort of cater to at Vivriti AMC.
The other thing is, Dipen, do you see some chances of some mutual fund companies coming out with their AIFs? They want to have similar sort of underlying the way they were having it in the mutual fund side, or it is not possible in Cat 2 and they might have to go to Cat 3?
No, see, if they are coming into AIF, they will have to sort of up the ante in terms of the quality of papers. So, see, investing in a AAA paper, for example, is requires an altogether different skill versus investing into highly undiscovered, underpenetrated mid and small corporates, for example, which are rated in A or triple B categories. So the skill sets, the amount of effort, the quality of people, time, underwriting skills are very different in both the segments. While mutual funds players would and can operate in the airspace, but they'll have to sort of then match with what is the return being targeted by other AIF categories and sort of match up to that level for coming into this space.
Is it may not be feasible also from a cost
Yeah.
point of view, the structure point of view. And even if you have to do the same thing, you would rather do it in the mutual fund side, because there also you'll have to pay taxes, right? On the same instrument, let's say you buy into corporate bond funds, so corporate bonds issued by even if it is AAA, you have to pay the same amount of tax what you're paying in the mutual fund side. You have to pay the same tax even at the AIF. So it doesn't make sense for any of the manufacturer to think in those lines. And the next question is there a concentration limit by SEBI, like the way you have it for debt mutual funds?
So, see, AIF by nature are less regulated as compared to mutual funds because SEBI believes that the investor who is investing is sophisticated enough to evaluate the risk on their own or through their partners or distributors. Uh, and the basic strategy. So, for example, at Vivriti AMC, because today we run 7 alternative investment funds. 5 of them have been rated. In each of our underlying investee company, none of our fund hold anything which is beyond 10% of the fund corpus. So we monitor a cap of, for some funds, we, for example, monitor a 7.5% cap. Some funds we operate at a cap of 10%. And that is again very well articulated to investors through our rating rationals of the fund as well.
And is there a sort of loss protection or default probability in AIF? So like, this is the question. So how has been the track record?
So, for example, at Vivriti Asset Management today, we are managing an AUM of more than 2,000 crores across the multiple AIFs which we hold. And we have been investing for the last 3.5 years plus. As of date, we have not had even 1 day delay or 1 rupee delay on any of our underlying investments. There is no delay default by any of our portfolio companies at the AMC for we have now made investments in 90 plus transactions across 70 plus originators or issuers. None of those companies have faced any sort of stress, forget workouts or delays or defaults.
And what is this underlying risk? So again, the question is more from a risk point of view. What is the kind of risk which is involved in AIFs vis-a-vis the mutual funds? If it has to be apple to apple comparison, of course, these are two different investments, but still, if you can correlate and give some sort of answers to our investors.
Yeah, so see, in a mutual fund, for example, while, for example, there are certain categories of mutual funds, like your long duration funds, your gilt funds, for example, your other categories which play on the interest rate risk, right? So they take a call on duration. For example, whether is a good period now to take a call that interest rates have actually peaked. So that's the sort of call which they take. Those some categories take interest rate risk. AIF usually don't take interest rate calls. They are actually only taking accrual based strategy. Mutual funds, for example, may also be exposed to MTM risk because those are open-ended funds and those requires mutual funds to be valued on a daily basis using market rates. That creates a lot of volatility in the returns which the MFs are exposed. Again, which an AIF typically, because those are close-ended vehicles, usually follow accrual-based income. So that MTM is again not an impact. The risk which AIF usually are taking is basically a credit risk. Uh, so which typically in the mutual fund, apart from the credit risk segment or a category, those segments are not taking. So the risks are different. The nature of risk are very, very different between a mutual fund and an AIF.
Right. Suppose you are coming under the HNI or ultra HNI segment, your portfolio size is more than 5 crore, out of which you have, say, 70-80% into fixed income. Now, how do you see as an investor, what should be the asset allocation like? How much should go to AIF? How much should be remain in mutual funds? So those who have invested, of course, they don't have to pay because, but the fresh money which is coming in, for example, and if that's supposed to be deployed in debt funds, obviously will not go into debt fund completely the way it used to go. So, what is the kind of alpha that you see the difference in terms of alpha between the debt mutual funds and the AIFs?
Yeah, so first I'll answer your question around asset allocation. So uh, I would actually look at AIF allocation in the overall book. And for example, even with equity, right? First allocation of broad, uh, and obviously the asset allocation depends on the risk tolerance of investors, whether they have their risk tolerance is low, medium, or high, and depending on that, the nature of investment, the allocation to debt, equity, and ES can sort of go together. If I take our view, for example, my view is that equity and AIF actually deserves I would say a similar board eye view in terms of, because a lot of the AIF actually offer us a return which is now equivalent or more than what typically what we have seen in equity funds over a long period of history of, for example, large cap, mid caps, etc. So AIF allocation deserves a relook, and potentially even from the equity bucket. Uh, Investments in high yielding AIF strategies can be looked at, is a view. Uh, and when you're sort of talking of alpha, I think the alpha, for example, uh, uh, mutual fund typically, and especially the AAA oriented papers, would yield somewhere around 7% today. An AIF can all the way sort of offer a pre-tax, post fees and expenses return of somewhere right all the way from 10% to 12, 13, 14, 15. Depend obviously on the underlying risk. So the investor needs to decipher the risk well when they are sort of looking at AIF.
Uh, what about NRIs when they are investing and they were investing in debt fund? Obviously, they had a different taxation, and now that they are investing in AIF, so what? How much? I mean, what would be the impact?
Uh, yeah, so I think NRIs obviously can continue to sort of look at basis, for example, what is the tax impact on their current investment versus what is proposed, and they can sort of look at a lot of NRIs, for example, also deserve or are advised to relook at the allocation towards AIF and PMS for basically getting a higher post-tax returns for let's say assuming the tax benefit which they may enjoy.
Yeah. You're right. And what is the By the way, there is one disclaimer from our side. So, obviously, we are discussing what is the industry standard, and what has been practiced and what we have observed as an organization. But, you are requested to speak to your chartered accountant, and get the proper clarification on these aspects, because every individual will have different slabs and different, rates, etc. So next question is, what is the rationale for rating the funds?
Okay, that's a very good question. The rationale for getting the funds rated, our view as an asset manager was that AIF as a space is crowded and it is opaque. And when we say opaque, now for example, mutual funds, SEBI has done a very good job of categorizing every mutual fund into, for debt, for example, you very know overnight fund kya hai, liquid kya hai, or short term category kya hai, and so on and so forth. However, this categorization is missing in AI. Now, within AI, for example, as we sort of speak, performing credit is, for example, a very loosely referred term, and that's a term. For example, when we started our franchise, we coined that term. But that concept or that term differs from one asset manager to another. For us, what is performing credit, for example, is lending to operating companies who have a rating on their balance sheet. Who those are operating companies, those are bank funded, and so on and so forth. Now, what this rating does is that it is easier for investors to again decipher the risk and compare one AIF to another, which to our mind is currently missing, and we are making our efforts towards that. That gives an advantage for investors that there is an governance on the portfolios, for example. And the most important point is that there is a third eye which is sort of looking at how the fund is sort of performing, what are the rating or the boundary conditions with the asset manager was sort of working with. For example, if you look at our products, we have a clear allocation in terms of what rating we would sort of invest into, whether we invest X percentage in A rated instruments, Y percentage in triple B instruments, what is the entity concentration which we are seeing, what is the sector concentration, and so on and so forth. The investor now gets to know what is the risk which the asset manager has bucketed themselves to, and then sort of look at what is the return which the asset manager is now promising. Versus that, the comparison becomes easier, which currently is sort of missing in the AR space.
Yeah, and I would say that there are ways of evaluating these offerings. While this is at the nascent stage, what Dipen rightly mentioned, and there are no defined ways of looking at it. But at the same time, the way we do it is we do complete due diligence before we all and approve any asset managers in the fixed income space. We look at what is the DNA of the organization. Do they have the capability to identify, companies and stock, and of course the underlying investments. We also look at an extent of looking at how many calls have gone wrong, how many calls have gone right, and that gives us some sort of conviction that the really portfolio manager is picking up high conviction ideas when it comes to fixed income instruments. So these needs to be examined very, very carefully, and it's not something made very much available. Like, you don't have a value research online or something like .com out here, which can give you some kind of broad ratings based on their own algorithms, which also has its own limitations, I would say, to large extent, because that is not authorized by any regulator. It is their own algorithm and their own way of analyzing it with their own methodology. So I would say that you should speak to someone who is expert in this area before you take a call, and evaluate the underlying, which is very, very important. So I think with that, we'll conclude the session here. It was wonderful speaking with you, Dipen. So thank you so much for taking the time out and verifying all the points, and I'm sure the investor community as a whole will take the advantage of getting into AIFs even more meaningfully, and improve their overall taxation liabilities.
Thanks, Vikas. It was a pleasure to have been on the call. Thanks everyone for joining on the call. Take care.
Thank you, everyone. If you have any question, please reach out to me at vikas@aifpms.com, and we'll answer all your queries. Thank you.
Thank you.